Hey there, and welcome to my channel, The Paper Bag Investor. In today's video, I want to look at LMND, the insurance company, and lay out a possible 5-year price target and an argument on why the price, or the market cap, or the share price of LMND could potentially 10x in the next 5 years. So let's get into it. Before I go any further, I just want to make it absolutely clear, I'm not a personal financial advisor, just a guy with a paper bag on his head who loves investing and thinking about the future. If you love investing, you love thinking about the future, you want to do better with your investments and look for high growth, long-term investments to really grow your portfolio with, I encourage you to subscribe to my channel. That's my kind of investing philosophy and the companies I look for and the companies I present in a nutshell. So can't guarantee your portfolio's returns, but it's in the bag that subscribing to my channel should help you become a better investor and should help you identify these kind of companies, or at least get them on your radar. So without further ado, let's get into today's video. Again, I'm going to look through some of the numbers, make some assumptions, and sort of project out 5 years what LMND could look like. So here we go. Okay, so if we're looking 5 years out for LMND, I took some of this data from, this is just from their last earnings report. They had, I'm going to look first of all at their customers, how that could project out for 5 years, their in-force premiums, how that might project out over 5 years, and their premiums per customer over that time span, and then get a total in-force premiums and apply a gross ratio to kind of see what their gross earned premiums could be in 5 years. So if we think about it, they had 260,000 customers 2 years ago, and then the end of Q3 last year they had 941,000, which represents about a 3.6x growth over 2 years. You do the math, you get about a 90% compound annual growth rate for year over year in the last few years for customers. I find a lot of people, I'm not sure if they really understand this as just a discounted cash flow formula, the future value, present value formula. If you don't understand this and you'd like to understand this, it's really simple actually. It's kind of the building block of a lot of financial analysis and discounted cash flow analysis. Just let me leave a comment down below if you'd like me to do a quick video explaining how this works so you can understand better when people say, oh, it's a 10x growth over this time span, or it's a 20% compound annual growth rate over this time span. What does that really mean? How those will sort of compare? If that interests you, drop me a comment. You get a few comments, I'll do a video on that. Okay, so let's say if right now, looking out, say, for at least from Q3 of last year, they had 941,000. We know they have more customers now because we know they passed at least 1 million at the end of last year. But anyways, we're going to go from that point on. They had 941,000, and we're looking out 5 years. And I'm gonna, if we continue with that 90% compound annual growth rate for the next 5 years, you'd have 23.3 million customers. I've done a sort of a spread of numbers. So if we go higher than that, really, bullish, and which is possible because something like this, they just expand into new markets and current markets. There's more and more young people, especially they're attracting, join in. You could even grow at a faster rate than that. So say it's 105%, you get 34 million customers. Even the really sort of more extreme bullish case, 130% for year over year for 5 years, you get 61 million. It's definitely not impossible. If you look lower, you get about 75%, you get to 15 million, 50%, you have 7 million. And then we're going to look at, okay, so that's kind of your spread from 7 million to 61 million, with maybe the more probable being 20-some million in 5 years' time customers. Kind of a potential outcomes, right? And then if you look, their in-force premiums, just look for again from the earnings letter, they're about 35.6 million, and they had 188.9 million. So these are all the insurance policies that are in place and how much they're worth, basically. So you'd actually take those numbers and then you use your customer data as well, and you get a premiums per customer. It was $137 per customer on an annualized rate back then, and now it's at the end of Q3 last year it was $200, which makes sense. Renters insurance, they charge like $9 a person. That's lots of people are just buying renters insurance. Of course, this could scale up much higher because that's their whole goal, is they want to attract young people that are going to be more tech savvy and jump on something like LMND app and learn about it, know about it. And then as they get older and they buy a house and they get married and they have children, they want life insurance, they're going to spend more and more on insurance and could easily spend $1,000, $2,000, $3,000 a year, depending on if they own a few properties, etc. And but currently that represents 1.46x growth in 2 years, which is a 21% compound annual growth rate. And it kind of, as I mentioned here, put an asterisk, this could be higher as simply as age increases, they might kind of have an exponential growth as the bulk of users start getting older, but also depends how many users of all those customers, millions of customers, how many of those are younger people, to get your overall average. So we're going to kind of, again, use this $200 as a premium per customer right now, and then go out 5 years at 16%, 21% kind of as my middle ground. Middle ground one would get you to, if you do that 21% growth, continue to give about $500 per customer, which might make sense because maybe half your customers are getting older and maybe you're spending $1,000 plus, but then you have another half of your sort of customer base is young people that may be spending $100 and some dollars per person. It could get you around that $500 and some dollars, right? And then, but of course, if you scale, I did a few more levels. You go faster, like 31%, you get $700, $600. You go lower, you get $400 and some dollars. That kind of gives you, again, that spread. And I think this could skew higher to the eventually where you could have like an average of $1,000 a customer, or you might just get more and more and more and more customers. Maybe this is like, even past 5 years could grow to 100 million. And it's still at this level, but lots of those people are young people that are just getting renters insurance, or maybe their pet insurance, etc. But so it gives you some idea. Now we're going to look at an Excel sheet that kind of tabulates this. Okay, and just looking at this Excel sheet, basically you're plugging in these values into a tabulated form. We get to take the total premiums, say, and you have the spread of premiums per customer. So maybe it's $400 to $771, kind of taking the average of this one, which is your $519, and then your customers in millions, so between 7 and 61 million, and again 23.3 is kind of my middle of the road. You do the math, you kind of give a spread, the low end about 2.9 billion in total premiums, the very, very bullish be like 47 million, maybe the sort of middle ground, maybe more realistic, 12 billion. So it gives you some spread and some idea. And then if we take the gross earned premiums of this table and we apply 55% gross loss ratio. If you don't know what gross loss ratio is, that's basically how much of the premium gets lost. So right now they're at about 70%. They've been declining. I'm sure as Lemonade has new products, this could be higher, and then it should decline over time, hopefully, if they have a data advantage. So I'm saying 55% means basically 55% of every dollar that gets put in here gets tossed away or used up, gets used in insurance claims. And so if you apply that number here, you get this spread of outcomes of anywhere from 1.3 billion to 21 billion, maybe middle of the road, 5.4 billion. You scale up, maybe 9.7 billion in there. Kind of gives you that skew depending on how much premiums per customer you're earning and how many customers there is. And of course, whatever the gross loss ratio could change quite a bit. If that was higher or lower, it would affect that as well. And then, so we're kind of have to look at this and you say, okay, well, what if you could go further? You could look at their operating costs and try and estimate that. I'm just going to try and take an estimate from your gross earned premiums and apply that to the number to see what this could be worth. So you think about it, currently they have market cap of 8.7 billion, and they have something like 70 some million gross earned premiums from Q3 of last year to the previous the 12 months prior. And so it's the current gross ratio is something like over 100. Very, very high. If you think about the share price or the value of the market cap to how much gross earned premiums they make. So, but if you think 5 years out, maybe they give, instead of 100, that ratio is going to get compressed right down to maybe 10x. And you think about maybe this middle of the road one, which is $5.4 billion. You give that a 10x to that, the market's they're still only at 23 million customers. There's whatever, 8 billion people, and by that time going to be even more billions of people on the planet. They're going to say it could grow potentially much higher than this. I mean, this number could be way higher. It could be like 100 million people, because they just have this digital platform to grow exponentially. But I'm trying to be conservative with my analysis, and with 23 million, so okay, 23 million and your 5.4 here, again, that would give you the market cap. 10x of that would give you about market cap of $54 billion, this middle of the road one. And the current market cap is 8.7 billion, so that represents about a 6x increase over 5 years time. So yeah, it gives you some idea. That's a huge, if you can go 6x in 5 years, that's very good. And of course it could be higher. Say maybe they get more premiums per customer, maybe they're more $34 million, or maybe they're like still lower here but they're much higher in the customer base, so maybe they're 9 billion or maybe 14 billion. And if you apply a 10x, you know, then if you're at this one here, you know, this kind of position, you're 9.7 billion in gross earned premiums, and say they give a 10x multiple of that, that's going to be like $97 billion company. They're $8.7 billion now. You can see that's over 10x increase in 5 years, which is a phenomenal return on investment. So yeah, I'd love to hear what you guys think about all this. There's obviously lots of assumptions that I've put in place to make this model, and you have to really believe in the underlying foundation of the company, the underlying strategy of the company, which I do. I think is really brilliant. I've talked about some of that in my other videos, like why they could potentially even 100x. I don't think they're going to 100x in 5 years, to be clear. I don't even know if they will 100x, but they have the potential to 100x, as I talked about in my other video. And I think they have just the framework to grow. Even, you know, that one analysis, the sort of middle of the road number I was using of 23 million customers, to me that number could be much higher. If you think about the digital structure that they have to exponentially grow. Also, one thing they use right now is reinsurance for other products. So they're basically helping cover some of their own insurance risk with other companies that are helping them reinsure. I could do a whole video on the reinsurance and what that means, but I think that eventually will go away, and they'll be able to make actually more profit from their gross earned premiums. That 10x number I use for gross earned premiums, you could probably argue that could be higher, could be lower, depends what the market thinks of them and what their actual what their actual operating costs are costing them in 5 years time, and what their actual net income is. But I think this is a really good starting point to kind of see what they could be worth in 5 years time. And I'd love to hear what you guys think about this in the comments down below. If you enjoyed this video, please hit that subscribe button as well, and follow along with my channel as it grows. I'll be making sure to tell you guys when I'm buying stocks, when I'm selling my stocks, what I'm researching and why. And this is just one example of that. So hopefully you got value out of this. If so, please subscribe. Also, if you think somebody could benefit from this, somebody's interested in insurance, somebody's interested in investing, send them my videos, share my videos. That really helps me grow and helps other people you know get value out of this as well. And while you're at it, hit that thumbs up. Appreciate that as well. So thank you for watching. Remember, it's in the bag, and we'll see you in my next video.